Gas prices jumped 21% in a single month. That is the largest monthly gasoline surge since the Bureau of Labor Statistics began tracking the data in 1967. And it pulled the March Consumer Price Index up 0.9%, triple the rate of the month before. The annual inflation rate now stands at 3.3%, the highest reading since April 2024. The Iran war, which began at the end of February, is almost entirely responsible. Energy costs accounted for nearly 3/4 of the monthly increase, as disrupted tanker routes through the Strait of Hormuz sent crude prices sharply higher. What made this report particularly uncomfortable for the Federal Reserve is what the headline number concealed. Core CPI, stripping out food and energy, rose just 0.2% monthly and 2.6% annually, both 1/10 of a point below forecast. Services inflation was contained. Shelter inflation tied its lowest level since 2021. On the underlying trend, price pressures were actually cooling. That split is now the central problem. The Fed cannot act on the headline without risking tightening into a supply shock that may already be fading, but it cannot ignore 3.3% with consumer inflation expectations at 4.8%, up a full percentage point in 1 month. Fed official Mary Daly stated plainly that the oil shock means getting inflation down will take longer. Prediction markets now assign a 40% probability to 0 rate cuts in 2026. Iran added a second pressure point this week. The Islamic Republic announced plans to charge oil tankers passing through the Strait of Hormuz a toll, payable in cryptocurrency. The Iranian parliament published the plan in early April. Analytics firm TRM Labs confirmed that the Revolutionary Guard Corps had already collected up to $2 million in Bitcoin and stablecoins from tankers since mid-March. Ship traffic through the strait remains a fraction of pre-war volume. If the ceasefire holds and energy prices normalize, the Fed has cover to look through March's spike and hold its current rate posture through the summer. Goldman Sachs Asset Management's co-CIO of multi-asset said explicitly that today's number buys the Fed time. But every week that tanker traffic stays suppressed extends the energy shock into April's CPI reading, and that is the report that will force the Fed's hand. Consumer sentiment already fell to a record low of 47.6 in the University of Michigan survey, and most of those interviews were completed before the ceasefire. The benchmark to watch: weekly tanker transit counts through Hormuz and the April 10 oil spot price trend. If Brent crude holds above $90 through the end of April, core CPI will start absorbing the energy shock through jet fuel and freight costs, and the Fed's patience will become harder to defend.
One day after Meta committed $21 billion to CoreWeave's data centers, layered on top of a prior $14.2 billion agreement, Anthropic signed its own multi-year deal with the same company. CoreWeave stock surged 13% on Friday. 9 of the top 10 AI model providers now use CoreWeave's infrastructure. The only holdout is Elon Musk's xAI. CoreWeave's position reveals something structural about the AI build-out. Hyperscalers like Microsoft, Google, and Amazon are spending aggressively on their own data centers, yet they still turn to CoreWeave to bridge capacity gaps. The company now carries $21 billion in debt on its balance sheet and just raised another $3 billion to fund the Meta deal. CEO Mike Intrater described the situation plainly. Scaling is expensive, and the opportunity is generational. Anthropic's growth makes the urgency clear. The company's annual revenue run rate crossed $30 billion this quarter, up from $9 billion at the end of 2025. That is a more than 3-fold increase in roughly 4 months. Claude's adoption curve, particularly the Claude Code product, has been steeper than anyone projected, and Anthropic now needs infrastructure it cannot build fast enough on its own. Amazon's positioning is the broader tell. CEO Andy Jassy, in his shareholder letter this week, compared AI's adoption speed to electricity, but noted AI is moving 10 times faster than electricity did. AWS reported an AI revenue run rate above $15 billion in the first quarter, growing rapidly and constrained only by capacity limits the company is working to close. Amazon stock rose nearly 14% this week. Jassy stated that the company already has customer commitments backing a substantial portion of its planned $200 billion capital expenditure for 2026. The tension embedded in this chain is leverage. CoreWeave is taking on massive debt to fund infrastructure that its customers urgently need. As long as AI adoption accelerates, the math works. But CoreWeave's debt load, now approaching $30 billion across its facilities, means any demand slowdown would compress cash flow faster than the company could adjust. The company has no margin for error on utilization rates. The evidence right now points toward continued acceleration. Anthropic's run rate growth, AWS capacity constraints, and Meta's multi-billion-dollar commitment all point in the same direction. The verification point is CoreWeave's next earnings call, specifically its utilization rate and forward contract coverage. If those numbers hold, the debt is justified. If utilization slips below 85%, the leverage story changes quickly.
Tesla is heading into its 8th consecutive week of losses. The stock is down roughly 25% in 2026, making it the only Magnificent Seven member not participating in this week's broader tech rally. At the same time, retail investors poured $256 million into Tesla shares over just 5 trading days, according to Vanda Research. That divergence matters. Institutional positioning and analyst consensus have turned cautious. JP Morgan analyst Ryan Brinkman carries a sell rating with a $145 price target, implying more than 58% downside from current levels. Analyst Gordon Johnson of GLG Research put a $25 target on the stock, calling it the single greatest stock short in market history. Their shared concern is valuation. Tesla trades at roughly 175 times forward earnings, while deliveries missed estimates in Q1. Chinese sales fell 16% year over year, and the $7,500 federal EV tax credit expired in September 2025. Retail buyers are betting on the roadmap, not the fundamentals. Musk promised a 1 million unit per year Optimus robot factory, a fully unsupervised robotaxi rollout in Austin, and a cheaper Model Q. None of those catalysts have arrived. Q1 deliveries of 358,023 fell short of the analyst consensus of roughly 365,000. Energy storage deployments came in at 8.8 gigawatt-hours against an expectation of 14.4. The stock's next defined catalyst is earnings on April 22nd. The options market is pricing significant volatility around that date, which itself is a signal. The market is uncertain about the direction, not the magnitude. If Musk delivers concrete timelines on robotaxi unsupervised operation and Optimus production ramp, sentiment could shift quickly. If April 22nd produces another set of delayed timelines and missed metrics, the retail buying will have provided liquidity for institutional sellers. The weight of evidence leans toward continued pressure ahead of April 22nd. The fundamental picture, declining margins, missed deliveries, competitive pressure from BYD and China, has not improved. But the recovery scenario is specific. A confirmed date for unsupervised robotaxi commercial deployment would give the stock a concrete event to price. Without that, Tesla is a story stock without a near-term story, and that is a difficult position to hold through a rising inflation rate hold environment where the discount rate on future cash flows stops falling.